having a proper investment portfolio is crucial to growing your net worth and having success in your investing career. Today in this video, we are going to talk about 3 really great portfolios that you can consider having when it comes to developing your own index fund portfolio. And more specifically, we are going to be focusing on broad-based index funds. Broad-based index funds are index funds or mutual funds or ETFs that track a certain market index and try to mimic the results of that index by investing in the same kind of securities. And like I just said, this can refer to both mutual funds or exchange-traded funds, also known as ETFs. And they both work great for an individual investor that wants a simple portfolio that has great returns and very low fees. And those are the main reasons why you should consider having your portfolio in pretty much all index funds, because they keep things so simple, they have very low fees, it allows you to diversify your investments basically instantly, and historically it's had some pretty great returns for investors that choose this kind of portfolio. And with that being said, I have 3 really great portfolios for you to consider in your index fund investment portfolio. And the very first one is probably one that I would actually recommend the least amount, but I'm getting it out of the way first, and that is the one fund portfolio. So the one fund portfolio sounds crazy, right? Just having one thing in your entire investment portfolio. That sounds like it's very undiversified, but that is not true, because this one fund that I am referring to is known as a retirement target date index fund. So what a retirement target date index fund is one index fund that basically tries to invest in almost everything. Then over time, this index fund automatically adjusts its asset allocation from more stocks in the beginning of the fund to less stocks in the end of the fund, and more bonds at the end of the fund and less bonds at the beginning of the fund. This portfolio automatically adjusts its ratio between stocks and bonds over time. So let's say that this target date portfolio invests in, the world stock market and the US bond market. Well, initially, depending on the time horizon, it's going to have more stocks and less bonds. And then over time, as it approaches its target date, it's going to have, more bonds and less stocks. So for example, let's say this target date is in 2050, 30 years from now. Well, 30 years from now is a relatively long time. So right now it might be invested primarily in stocks, let's say 80% stocks and 20% bonds. But once it gets closer to 2050, let's say now it's 2045, and you have 5 years left until that target date, it might have adjusted over time to be, let's say, 40% bonds and only 60% stocks. And then once it gets to 2050, maybe its strategy is 50% and 50%. So that is how a target date fund portfolio works, and you're going to have to look at whichever one you are considering investing in to see what its strategy is and when it's going to adjust. So the longer of a date that you put on there, say, a target date that's 2060, that's 2070, 2080, the longer it puts, more likely it's going to have more stocks initially. And while that's great that it's super simple and you only have to worry about, one thing in your portfolio, this is my least recommended option. This is for someone that doesn't want to manage their portfolio at all, but still wants those pretty low fees. So this one actually does have higher fees, but generally you can actually get these with some pretty low fees, because for the most part, it's going to be automatically adjusted and not going to require active management, especially if it's investing in pretty much everything. But still, this means that you do have less control of your investments. Let's say you're nearing your target date, and that was 2050 and it's 2045, but it's automatically selling off some stocks and buying more bonds. But let's say at that exact same time that the stock market is not doing so well. So that fund is essentially selling off stocks at a loss when it would have been more strategic for you yourself to hold on to those for a little bit longer until the market recovered. But this fund is going to automatically sell pretty much no matter what, according to what it's designed to do over a certain amount of periods. So this gives you less control over your investments if you are completely relying on that target date fund. And it does have a little bit higher of a fees than some of the other funds I'm going to talk about. However, like I said before, if you want nothing to do with your investment portfolio, or maybe it's your only option, let's say in your 401k at work, it's probably a better option to select that retirement target date fund if it invests broadly, than to say, let's say, invest in only one stock, maybe your company's stock purchase plan. This retirement target date index fund might be a better option than that. But let's move on to portfolio number 2. And this is going to align straight with the numbers, but portfolio number 2 is actually the 2-fund portfolio. So instead of having only one asset in your portfolio, you're going to have 2. So with the 2-fund portfolio, you kind of divide things up a bit. And with a two-fund portfolio, you're going to have the total world stock market index, and you're going to have the total US bond market index. So this gives you control over how much you have invested in stocks and how much you have invested in bonds. So you can allocate differently among the two. Say you want 90% stock and only 10% bonds, or 50-50, whatever you want to do, you can adjust that yourself. But it only takes two funds to be invested so broadly in the entire world stock market, as well as the entire US bond market. And while this two-fund portfolio can be a great option, I think we need to take it one step further for the best portfolio, the one that I personally use and I highly recommend because I've had great success with it. But before I move on to that, I just want to say really quick, if you are enjoying this video, please like it, give it a thumbs up. It really helps me out. I really do appreciate it. While at the same time, you should consider subscribing to the channel and hitting that bell for notifications, because every single week, currently Tuesdays and Fridays at 8 a.m. Pacific Standard Time, I am putting out new videos about investing, about saving money, about growing your net worth, and I just know that there's something that I can help you with. But now let's get on to number 3. And portfolio number 3 is actually the 3-fund portfolio. So this 3-fund portfolio is what I personally use and what I personally believe in, because it has total US stock market index fund, a total international stock market index fund, and a total US bond fund. So you still have stocks and bonds from around the world, but when you have this 3-fund portfolio, you're able to then allocate more or less to, let's say, your stock market index and your international index. Whereas with the 2-fund portfolio, your total world stock market index, it's probably going to be adjusted based on the capitalization of each country. But with the total international stock market index and the total US stock market index separately that you have in the 3-fund portfolio, you can adjust, say, and invest more in the US or less in the US and more international, however you want to do it. So you can adjust your allocation, 3 different ways. So even if you want to have, an 80-20 split between stocks and bonds, you can do that. You can have your 20% in the bonds, you can have your 80% in the stocks, but you can adjust how much of that 80% is going to be US and how much of that 80% is going to be, the rest of the world. And so out of all 3 of these portfolios, I believe that the 3-fund portfolio is one of the best portfolios for individual investors, and it's the one that I currently actually use, and I pretty much used my entire investing career. But that's not all you need to know about investing. There are so many more things to learn, such as rebalancing and how you rebalance. That's also crucial. And asset allocation and how you're going to adjust that allocation based on your risk tolerance, your time frame, and your goals. And there's so much more to learn, and that's why you need to subscribe to the channel, and you need to watch this video that I made, if you haven't already, called How to Achieve Financial Independence in 10 Years or Less, because it is a full guide to growing your net worth and becoming a master of your own personal cash flow. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.